Greetings, everyone. It's Saturday, February 7th, and I need your attention because significant developments are happening in silver at this very moment, not in the future, but right now. We've witnessed violent market action, sudden reversals, and multiple indicators all pointing toward the same conclusion. The paper silver market is experiencing strain while physical market signals are intensifying rapidly. Last night's silver market activity delivered one of those jaw-dropping moments that demands attention. Prices lurched dramatically, spreads exhibited unusual behavior, and discussions across precious metals communities shifted from casual optimism to genuine urgency, the kind that emerges when participants question whether adequate physical metal backs all outstanding commitments. Before continuing, I'd like to request something simple. My data consistently shows many regular viewers haven't yet subscribed. If you find this content valuable, please subscribe and leave a brief comment, even just John AG. It matters more than you realize. Let's address the persistent rumor appearing in my communications. People are suggesting certain major silver producers may be withholding their output from traditional paper market channels. Simply stated, the rumor indicates some significant players are reluctant to supply the exchange system anymore. I cannot verify this, and I'm not asking you to accept it as confirmed fact, but consider this. If any portion is accurate, it fundamentally alters the situation. Paper exchanges depend on consistent supply inflows, confidence, and the assumption that delivery always remains feasible. Here's what makes this interesting. Such rumors don't circulate because people are idle. They spread because the current environment makes them plausible. And the current backdrop is screaming tension through inventory levels, premiums, delivery timeframes, and unusual east-west market behavior. What triggered this heightened concern? A dramatic event occurred on a major Asian silver futures exchange. Multiple accounts allegedly violated volume restrictions, prompting the exchange to announce sanctions. This matters for two critical reasons. First, it indicates abnormal trading activity. Second, it demonstrates authorities noticed and felt intervention necessary. When a futures exchange openly acknowledges certain accounts crossed boundaries and imposes restrictions, that's not routine news. It's a warning signal. It suggests stress, crowding, and attempts to force specific price outcomes. Was this simply an orderly correction? No. It appeared more like sudden deployment of synthetic supply, the kind created through contracts, not through mining, refining, or physical bars. When massive virtual quantities can materialize within minutes, you're not observing mining operations. You're witnessing leverage dynamics. Now let me address the fundamental question. Are we closer to an authentic silver squeeze than we've been in years? I believe we're closer than we've been in considerable time. Not due to a single chart or isolated rumor, but because multiple typically separate factors are beginning to converge. Let's discuss the U.S. futures market, the prominent paper exchange everyone monitors. The critical metric isn't headline prices, it's registered inventory, the category actually available to settle contracts if buyers demand physical delivery. Another category exists called eligible, but eligible simply means metal meeting standards while owned by others. Eligible doesn't equal deliverable. When you learn hundreds of millions of ounces are open on major contracts, while registered inventory hovers around just over 100 million ounces, you should pause. Even if only a fraction of contracts demand delivery, the mathematics become constrained rapidly. In calm markets, most participants roll contracts forward, close positions, or settle financially. They want profits, not physical trucks. But markets cease being calm when trust falters. Trust falters when people notice warehouse depletion, persistent premiums, and when regional price spreads resist normal arbitrage closure. Here's the conservative scenario under discussion. Suppose only 1/4 of open contracts demand delivery. Even that could consume most deliverable inventory. Now imagine stress intensifies, headlines amplify, and more buyers insist on physical metal. Half demanding delivery would create problems. More than half would create crisis. There's another uncomfortable reality. Registered inventory has been trending downward. It fluctuates daily, but the directional trend matters. If deliverable metal continues shrinking into delivery months, the exchange has reduced flexibility precisely when needing more. I'm not predicting catastrophe. I'm explaining pressure points, because pressure points are exactly where squeezes originate, not in loud predictions, but in quiet mismatches between promises and inventory. This brings us back to Asia. While the Western paper market appears somewhat inverted, I'll explain shortly, Eastern physical pricing maintains premiums. The premium has occasionally narrowed but persists. The direction of influence matters. When the East commands higher prices, it tends to pull the West upward, not vice versa. Let me explain contango and backwardation in plain language. In healthy commodity markets, futures typically price slightly above spot due to storage, financing, and time considerations. This normal condition is called contango. Backwardation is the reverse, spot trading above futures, meaning people pay extra for immediate delivery rather than future promises. Backwardation isn't automatically disastrous. But persistent backwardation in silver serves as a warning indicator. It can signal supply tightness, urgency, and distrust in future availability. What have we observed recently? The Western market flirting with backwardation, while Eastern markets appear comparatively normal. This isn't expected if everything flows smoothly and plentifully. Layer onto this reports of unusual refiner and dealer behavior. Some sellers are overwhelmed with incoming metal, others are rationing product. Premiums vary wildly, and physical bid-ask spreads can widen so dramatically that trading becomes impractical. When physical spreads are chaotic, it indicates the distribution system isn't flowing like a calm river. It's moving like congested traffic. Where does the short squeeze element emerge? It materializes when large short positions exist, and shorts cannot source adequate metal if delivery is demanded. If shorts can always borrow, roll, or cash settle, they survive. If crowds demand metal, shorts must locate supply. When supply is scarce, price becomes the leverage tool. We've heard about substantial short positions associated with major Asian participants who previously achieved enormous gold profits. Again, I'm not asking blind acceptance of this narrative. I'm asking you to note the structure. Large shorts represent decline bets, and they attract attention when inventories tighten. Simultaneously, across the ocean, wealthy buyers reportedly continue accumulating physical holdings. This creates a compelling narrative: physical accumulation versus paper aggression. Narratives can mislead if they blind you, but narratives also form because friction exists in the data. Let's not forget broader context. Silver isn't merely a collectible coin story. Silver is an industrial necessity flowing into electronics, photovoltaics, defense systems, medical applications, and modern transportation. When industry requires silver, it doesn't consider your opinions. It prioritizes supply continuity. This explains why silver markets can move shockingly. If manufacturers fear shortages, they don't wait for bargains, they secure supply. This behavior can transform steady markets into scrambles. Back to the paper to physical ratio, this figure is the elephant in the room. Various estimation methods exist, but the basic concept is simple. Paper claims on silver vastly exceed silver that can actually be delivered. Even if the ratio has improved, it remains shockingly elevated. Imagine a stadium full of people holding claim tickets with a tiny truck outside containing actual product. Most days, nobody wants the truck. They just trade tickets. But if enough people walk outside simultaneously demanding what their tickets promise, the system panics. Consider this. If only a fraction of paper claims required settlement in real ounces, global supply would strain. That's the core vulnerability, explaining why squeeze keeps recurring in conversations, even when people tire of hearing it. Another ingredient: margin changes. In past cycles, raising margin requirements cooled rallies or forced weak hands out. These days, margin changes still matter, but may lack the same power when the underlying issue isn't speculation, but availability. Then there's circuit breakers and volatility controls. Many assume hard daily limits exist in futures markets. In practice, you often get dynamic halts, rolling time windows, and brief pauses. Short pauses can reset order books, but don't solve shortages. They don't create silver. They merely slow panic momentarily. If markets move violently, a 2-minute pause is like closing your eyes hoping the storm stops. When you reopen them, the storm persists. Let me pose questions for the comments, because I want genuine perspectives, not just headlines. Do you think paper exchanges should be required to match open interest with stricter inventory standards? Or do you believe cash settlement is acceptable? Share which side you're on and why. Second question: if choosing one signal to watch for a true squeeze, shrinking registered inventory, persistent Asian premiums, or Western backwardation, which would you select? Share your answer below. We need to discuss gold because silver and gold are moving in tandem again, and gold reserve rumors are resurfacing. We hear claims, counterclaims, and political noise surrounding gold held in national vaults. You've heard the famous vault references and the arguments. Is it all present? Can it be verified? I won't pretend I can open vault doors for you, but I'll say this. When trust erodes, people question everything. When they question everything, they stop accepting paper promises at face value. This psychological shift can amplify silver because silver is the smaller, tighter market where minor behavioral changes create major price results. We also have historical frustrations of countries requesting gold repatriation, with processes taking far longer than expected. When repayment or delivery requires years, it invites speculation. Speculation is fuel, sometimes poor quality fuel, but it still burns. Stepping back, what is today's market communicating? It's indicating the physical and paper worlds aren't perfectly aligned. It's showing different regions value immediate metal differently. It's demonstrating some participants aggressively bet on decline, while others quietly accumulate. What should you do with this information? First, don't let adrenaline control your account. During chaotic moments, physical premiums punish buyers and sellers alike. You can lose money even when correct because spreads widen and liquidity evaporates. Second, if you're a long-term holder, remember, volatility is designed to shake weak hands. The metal lacks emotions. The market has emotions and will test you. Third, if trading paper products, understand what you own. Futures contracts aren't bars. ETF shares don't equal delivery. Paper can be useful but misleading if you assume it's equivalent to physical ounces in your possession. I need to say something politely. We're campaigning against copy-paste channels that recycle and repackage content. If you want to support original work, please subscribe and leave any brief comment so algorithms recognize your presence. This small action helps prevent the channel from drowning in copycats. Regarding community, if you're succeeding, whether you've made progress, built savings, improved trading discipline, or experienced success, share a sentence or two in comments. Your story can uplift struggling individuals and remind them consistency wins. Now for a cliffhanger. The next delivery window is where this narrative either cools or explodes. Because if registered inventory continues thinning and more buyers take delivery, the paper system must prove itself. When systems are forced to prove themselves, they often reveal weakest links. But there's another layer most miss. The spread between spot and futures isn't just technical curiosity, it's a signal about urgency and confidence. When spot is aggressively bid, someone wants metal immediately. When futures are discounted, someone lacks confidence about later delivery or demands higher rewards for waiting. Does this always mean default? No, but it means tension. Tension precedes dramatic moves. Let me walk through a scenario. Imagine markets open and prices attempt sharp drops, but physical demand doesn't disappear. Drops attract buyers, inventory drains, and premiums stay elevated. Shorts feel secure because prices declined, but deliverable supply keeps shrinking. Then, sudden rallies force margin calls, and those short positions scramble to cover. That's how squeezes ignite, not linearly, but in pressure loops. Now imagine the opposite. Markets calm, inventories stabilize, premiums shrink, and delivery demand remains normal. In that scenario, squeeze talk fades and we return to traditional dynamics. This can happen too. That's why I'm not selling certainty, I'm selling awareness. Awareness means monitoring the right indicators. Watch registered inventory trends. Watch delivery percentages in active months. Watch regional premiums. Watch whether backwardation appears and persists. Watch whether refiners and dealers report constraints. These are the clues. Let me clarify it regarding rumors. Rumors aren't facts, but rumors can signal fear or greed. When enough independent people repeat similar rumors, it's often because they sense change. Sometimes the change is real. Sometimes it's hysteria. Your job is staying calm and evaluating. In this moment, the strongest stress evidence isn't social media. It's warehouse data, premiums, and curve structure. I also want to discuss the phantom ounces concept because it confuses people. When trading paper silver, you can create exposure without touching physical. This isn't inherently wrong. It's how many markets function. Problems emerge when paper markets grow so large they dwarf physical deliverability, and when participants forget paper represents claims, not the commodity itself. This is why some say paper prices can be managed while physical becomes scarce. If physical is scarce, buyers pay premiums and effective prices diverge. Eventually, that divergence forces reckoning. Either physical supply returns or paper credibility weakens. Final reminder, by the time you're watching, a members-only video may already be available. If you want one place where I compile full timelines in extra depth, consider joining membership. It's also a simple way for me to identify closely engaged followers, and I appreciate that support. Let's conclude soberly. We're in a rare moment where silver's narrative isn't just directional, but about paper versus physical, regional premiums, delivery mechanics, and confidence. These are ingredients for major moves. Now I hand the microphone to you. Do you think the next big silver move will start with physical shortage signals or paper market shocks? And what would you do if regional spreads suddenly widen again? Let me slow down and explain why that Asian exchange announcement matters. Exchanges rarely admit problems. They prefer calling everything orderly trading and moving forward. When an exchange publicly identifies certain accounts saying, "You crossed limits and we're restricting you," that's a warning flare. It indicates the move wasn't normal flow. What does a paper hit typically look like? It's a wall of selling dropped into thin moments, not because sellers want optimal prices, but because they want maximum reactions. If you wanted good execution, you'd stage orders gently. If you wanted panic, you'd slam bids and let stop losses cascade. This event grabbed attention because it didn't occur in isolation. It landed atop other building stress signals: thinning deliverable inventory, regional premiums, and odd curve behavior between spot and futures. Inventories are stubborn. Opinions can change daily, ounces don't. That's why registered inventory keeps surfacing. Registered is the category usable to settle contracts if buyers demand metal. Eligible might meet standards, but it belongs to others and may not be available when needed. Some say eligible can become registered. True, but only if owners agree. Owners often demand higher prices when markets feel tight. That's the difference between theory and practice. Delivery mechanics aren't glamorous, but they're the plumbing. As active contracts approach expiration, participants decide whether to roll, close, or stand for delivery. In calm markets, most choose paper settlement. Under stress, more consider delivery. That's when mathematics become uncomfortable. Here's the key. Squeezes don't need everyone. The system assumes most participants won't request metal, so it can carry huge paper exposure atop relatively small deliverable piles. When behavior shifts even slightly, the ratio becomes vulnerability. This is where the curve matters. In healthy markets, futures usually price above spot due to storage and time. That's contango. When spot trades above futures, that's backwardation, often signaling urgency. It can mean paying extra for immediate delivery because future delivery is uncertain or inconvenient. If the West shows backwardation moments while the East looks more normal, that's a clue suggesting the Western pipeline feels the pinch. Add the short position narrative. Large shorts are decline bets. Under calm conditions, large shorts simply represent confidence. Under stress, they become potential forced buying sources. Rising prices create margin pressure. Rising delivery demand creates a sourcing pressure. Either can push shorts into covering mode, and covering mode can become loops. Covering pushes prices up. Higher prices trigger more covering. That loop is the squeeze loop, not magic, just mathematics plus human emotion. Keep one historical lesson in mind. In recent years, another industrial metal experienced sudden squeezes, forcing emergency exchange decisions and shocking traders who thought that can't happen here. The lesson, extreme leverage plus tight deliverability can produce gaps and rule changes. Silver has similar ingredients, that's why people watch so closely. Let's bring this to street level. If you visit physical dealers, you hear completely different stories depending on location. One might have product, but high premiums. Another might accept orders with delays. Another might prefer buying over selling because restocking is unpredictable. This inconsistency doesn't prove squeezes, but shows uneven flow. Uneven flow often precedes bigger moves. This returns us to producer rumors. Even if producers aren't formally boycotting exchanges, they can quietly shift supply. They can sell more directly, lock output, or demand different terms. If physical premiums are stronger elsewhere, incentives pull metal away from paper pipelines. Markets follow incentives. Gold vault rumors matter for one reason: trust. Whether accurate or not, they influence mood. When people question reserves, audits, and delays, they become more interested in self-custody. This shift can spill into silver because silver is smaller and more sensitive to behavioral changes. Here are 3 simple watch points for the next phase. First, watch registered inventory trends into delivery windows. Does it tighten or stabilize? Second, watch the curve. Does backwardation appear more frequently or disappear? Third, watch regional premiums. Do they vanish because metal flows or because Western prices jump to catch up? If 2 remain stressed, squeeze conversations stay alive. If you've navigated difficult markets successfully, share one practical lesson in comments. It can be brief and simple. Your experience can calm newcomers feeling nervous. Let's tighten the storyline before returning to markets. We had a sharp event on a major Asian futures venue with exchange response. We have a large short position narrative circulating. We have thinning deliverable inventory in Western systems. We have backwardation moments signaling urgency. We have regional premiums refusing to die. We have broader trust narratives around reserves. Each alone might be noise. Together, they form patterns. Here's the cliffhanger I want you to remember. If we see another attempt to slam prices, watch post-slam reactions. Does it bounce quickly? Do premiums stay firm? Does inventory continue draining? Reactions after hits reveal whether demand is stronger than paper pressure. Tell me in comments, are you watching silver mainly as investment, hedge, or long-term savings? And what single signal would convince you a real squeeze is underway? One detail that seems small but matters greatly is how exchanges handle sudden moves. People hear circuit breaker and imagine hours of stop trading. In many commodity contracts, it doesn't work that way. You often get brief pauses, order book reshuffling, then trading restarts with wider bands. This can slow runaway moves, but doesn't remove underlying tension. If volatility is driven by leverage and positioning, short pauses can make next moves sharper because traders return with fresh orders and stronger conviction. It's like taking deep breaths mid-sprint, then running harder. Margin changes work similarly. Higher margins can force some speculators to reduce positions, creating fast dips. But if physical demand is real, dips get absorbed quickly. In other words, margins can change who holds contracts, but can't conjure extra silver into markets. This is also why paper-to-physical ratios keep surfacing. When paper claims are enormous, markets can appear liquid on screens while physical remains finite. Many days that's fine because people trade exposure, not metal. But when fear appears, people want certainty. Certainty often means something tangible. If you're wondering why these stories become viral, It's because they combine drama with simple questions anyone can understand. How many promises exist, and how much product is available if people ask? Don't confuse excitement with strategy. If you chase moves emotionally, you can get hurt, even if long-term narratives are strong. The safest approach for most is choosing plans before markets move, not after. Decide what you're holding, why you're holding it, and what would change your mind. If you're still watching, here's another question I'd appreciate you answering. Do you think the biggest silver risk is price volatility or rule changes in paper systems? This question matters because it determines what exposure type you prefer. Finally, remember, markets often make loudest moves when most people are distracted. Keep your eyes on plumbing, not noise. Headlines catch up later. Please remember, I'm not asking you to believe, I'm asking you to watch. Watch how quickly dips are bought. Watch whether physical dealers tighten terms. Watch whether curves normalize or stay distorted. These are the breadcrumbs. If you see the same stress signals repeating weekly, that's when this stops being temporary scare and becomes structural narrative. If signals fade, that's also valuable information because it indicates the system found breathing room again. Either way, we stay calm, alert, and prepared together. Ladies and gentlemen, I'm John A.G. Thank you for your time. Please subscribe, leave a comment, and I'll see you in the next update.